This episode of Market Talk is brought to you by Growmark FS. Keeping up on the latest in ag is a challenge, to say the least, but there are experts nearby ready to help. You'll find them at your local FS. You can trust them to bring you customized agronomic grain and energy solutions born of the latest thinking. That's because FS specialists receive continuous training that keeps them current on the latest trends, practices, and technologies. So you'll get local expertise that's both exceptional and up to date. Visit fssystem.com to learn how FS is bringing you what's next. And joining us now here as we broadcast live at Big Iron in Fargo, North Dakota, day number 2, and we are pleased to have with us in person for a Wednesday discussion, Mike Zuzolo, Global Commodity Analytics. Mike, it is good to catch up with you in person, sir. How are you?
Great to be with you, and great to meet you. We got to have breakfast this morning. What a wonderful time it is to get out in the fall and get to know people and make new friends. It's really great to be with you, Jesse.
I agree. Diener's Diner in West Fargo was fantastic food this morning.
Definitely get the cinnamon roll.
I agree. Or caramel roll, wasn't it?
Caramel roll.
Yep, yeah.
Right.
Well, enough about our breakfast. We got plenty to talk about the markets here, Mike. Just thinking for starters, Wednesday's trade action. A little bit of pressure, quarter beans, wheat doing okay. It feels like the trade really just has a lot of other factors that are kind of weighing on it right now with this potential rail strike, the CPI numbers yesterday, the PPI numbers today. It just feels like there's a lot of outside factors weighing into the commodities and really don't know what direction to go in Wednesday's trade.
Yeah, I think they're biting off very small bites right now, Jesse, and I think Wednesday showed us that. If you take a note of the two big winners, or the biggest winner and the biggest loser, I should say, the biggest loser was the September bean oil, down around 5%, and I think that was indicative of those September futures going off the board today. And so you had a lot of spread cleanup, I think, when it came to the soy complex in general. We've also gotten some news that the Brazilian crop is underway as far as planting. That freshened up our news cycle today as well in the soy complex. And Chicago was talking a lot about the harvest pressure today for some reason. Is it because it's early? Is it because they're getting some numbers in? Yes and yes. And so that, I think, impacted the row crops. Biggest winner today, though, was hard red wheat. Kansas City hard red wheat up 15 to 20 again. It's been a contrarian in an otherwise negative market, and I think this is where it goes back to the drought in Kansas and also the uncertainty about Ukraine, because we're getting ready now to have the Russians, the Chinese, and the Turks get ready to have a face-to-face conversation here in a couple days. And does that spell the end of the grain deal? I think maybe the trade is trying to price some of that in along with the drought in the southern plains.
Well, let's break some things down a little bit. I think just for starters, you mentioned some harvest pressure out of Chicago. One has to wonder, okay, maybe that is a little bit, this is that typical time frame. But I know the rail strike is a big issue. I think we should divert our attention there a little bit. Still waiting on news. I know you've heard some news out of Chicago, some thoughts about what could happen with this, but this rail strike would have far-reaching impacts, not just agriculture, but just across our entire supply chain, et cetera, Mike.
Excellent point. And I think what I am hearing in Chicago and the traders' mindset right now, Jesse, is that we haven't really even tried to get our hands around it because we think there's an 11th hour deal coming here at this point by the Biden administration, and they're going to come in and keep the trains running. However, there's already trains that are shutting down at this point. And I think this goes back to your bigger point. These types of issues, these supply side issues, they've plagued us since the pandemic, and they've plagued us since the war with Ukraine and Russia. They're not going to stop, I don't think. That's the type of inflation we're in. We're in that cost push inflation that you and I talk about a lot. Mm-hmm. So I think that's where it's going to be extremely volatile. Cash futures divergence is going to remain. I think about where we're at right now, Big Iron, Fargo, North Dakota. Where does essentially all of their crops go to from the export market? The rail line of the Pacific Northwest. I could see this being one of the hardest hit cash basis areas in the country if that rail strike occurs. And by the same token, have one of the highest corn bases that we've probably ever seen in feedlot country in southwest Kansas, until those feedlots just say, Uncle, pull the bids and start marketing cattle light. And I think that's what we're going to see if this rail strike lasts for more than a couple weeks. Unless there's a lot of freshly harvested corn in drought country, which I don't think there is, I think we've got a real issue on our hands in the Kansas feedlot country when it comes to marketings and pulling those marketings ahead aggressively.
Well, I just think about, if there's a prolonged rail shutdown, what's that going to do for inflation, and then thinking about food inflation with the consumer at the grocery store. And it's just that trickle down effect of everything. And if it's, more than a couple of days or a week, if we talk a month, I can't imagine where things would end up. To your points as well, thinking about feedlot country and getting feed down there, et cetera. There's a lot riding on this potential rail strike, and if it happens or not.
And I think this is where it could make everything else pale in comparison to the factors that we've been talking about the last 3 months. And why I say that is because of what you just said, the consumer, the prices, that cost push inflation, that supply-led inflation, it hits you because your consumer, their prices go sharply higher. And the raw material, the corn, the beans, it's trapped here in the United States. You got to get a substitute. You've got to find it somewhere else, and you lose that demand permanently.
Well, and I think as well, we got a rail issue on top of hotter than expected inflation numbers this week. CPI data came out, it wasn't a huge move, but 0.1% higher. Well, that's going to weigh on things. It's just kind of crazy to think about, with inflation, we keep hearing all this talk that, well, we're trying to get it under control, but it doesn't feel like we're getting it under control, Mike.
No, and I think what I have heard in my area in the commodity sector, Jesse, has been we'll look for the funds to roll into commodities to protect themselves and get some inflation buying done. I'm not a believer in that right now because it's more of a cost push, supply-led inflation. Yep. In fact, it's probably going to lead more to a deflationary mindset because of a recession. High interest rates, weak emerging markets, stronger dollar. If you see that and you're an ag producer, that's not going to encourage the funds, in my opinion.
Let's talk Monday's WASDE report that we saw. USDA surprised the trade with the soy numbers. A lot of numbers came down, not just yield, but production, harvested acres, I know crush, et cetera, et cetera. There was a lot of numbers that they changed on that report Monday. What are your thoughts after seeing what USDA printed in the September report?
Yeah, the big thing for me was the explosive move up and clearing out up to the resistance levels that we saw, and the market doing that on pretty heavy volume. We didn't see the follow through. And so I think we're in a window here of being able to go up and retest those highs depending on what the rail strike does. But we've also got another big demand issue out there, an investment issue, and that's the Fed next week. And what do they do with monetary policy? To your earlier point, if we're going to get inflation under control, the Fed is saying we're going to raise interest rates so high we may have to create some pain, i.e. in a recession. So that brings me back to I've got a window of opportunity here, I think, from the WASDE report to go up, retest $6.95 in D's corn, $14.95 in Nove beans. If we can go above that on a closing basis, maybe then clear some stops, get some buy stops hit. And we've got gaps up around 7.25 in the D's corn, up around 15.36 in Nove beans. Those are really areas I'd like to get a lot of hedging done, generally speaking, 30,000 feet. Not talking to individual clients here, just doing a program.
Sure, because, I think about obviously everything as it always is. It's case by case, it's region by region. And we definitely see that this year with the case of the haves and have-nots. And as you look at these corn, November beans, and think about, okay, now I have a pretty good handle on what I have or don't have with my crop. Now's probably that time to find some floors, it seems like, and really to make some moves as you're getting ready to head to the combine, or at least have an idea of what you want to do, Mike.
Exactly, because we've got premium built into the market now after that report. Excellent point. And I think that's exactly where producers need to be thinking about that, because take the rail strike off the table for a second. We've got Ukraine and we've got China. And those two things could go either way. And so I think in my mindset, you really got to be in the mindset to get the hedges on the books, do it on paper for the most part, and then find out where your base is. You're going to have to feel your way through the cash basis side of the equation. It could be pretty rough for a processor, but at a river terminal, it could be fantastic.
Sure. Very, very true. Mike, let's talk as well a little bit about the wheat market. We watched spring wheat harvest is going fairly well across the northern tier right now. Looking at the central and southern plains, still pretty dry. Wondering what that's going to look like. What are your thoughts on this wheat market as it stands right now after the WASDE report?
I think we're getting to points now in the hard red wheat where the soft red and the row crops are going to have to pick it up here and get together essentially. And everybody, rising tide lifts all boats, Jesse, especially with some rain in the forecast next week in Kansas and Nebraska, some key hard red wheat country, and northern Oklahoma for that matter. So I'm kind of on pins and needles, maybe wanting to get some hard red wheat for the 23 crop hedged at this point in case we do get those rains and we have a pullback and corn and beans don't move up to those next levels like we talked about.
As well, I think about the 23 crops across the board. You mentioned wheat, corn, beans too. We've had this discussion before, talking with producers, some that are maybe looking at locking in some fertilizer, seed, chem, locking in some margins for next year already, just with a lot of the unknowns. What's your thoughts in that case? I mean, I would assume it's probably a case-by-case basis. If you have a number on your balance sheet that you're okay with, then it's probably, something they can go from there, I would think.
Yeah, I mean, that's a tough one. I think that's where I'm going to have to talk to somebody case by case. But generally speaking, if you can lock it in and you can make money because of where you lock it in, I think you got to take a hard look at it. But what I'm hearing more and more is that those numbers are off the table right now between the European natural gas issue with Russia and now the rail strike. I mean, that's one thing that rallied on Wednesday sharply was the energy market led by natural gas and then the crude. That I was getting feedback was indeed coming from the rail strike potential and end users actually jumping from natural gas over to heating oil this winter and playing the arbitrage because the heating oil is cheaper. So I think that's where it's going to get tougher and tougher, I think, to get energy-related needs locked in and have somebody actually as a supplier say, yeah, I'll book that this far out.
Well, you mentioned earlier as well, talking about, possibly Russia getting some ammonium out of the country through Ukraine and try and salvage this Black Sea, this grain deal for Ukraine. I think about that energy situation in Europe as a whole, though. That is a definite, I think, a true reminder of what we could see here if something catastrophic were to happen on the energy side moving forward, Mike.
Yeah, and this is where the rail strike comes into play. This is the big thing for the rail strike, because my assessment would be when things start like this, they take on a momentum, and it's very hard to unwind them. In other words, I think we have to assume that it's going to take several weeks to get it unwound if they actually do go on strike. And I do think that this is a make or break situation for the railroad unions because they see a lot of automation. They see a lot of AI coming in. And this is their Custer's last stand, so to speak, with us not being too far away from South Dakota.
Yeah, very, very true. Let's talk livestock a little bit. You mentioned cattle, and we were talking as well this morning just about feedlot country and trying to get feed in and how the rail strike could impact things. But looking at live cattle, feeder cattle, after the report, we fairly feels like we've kind of chopped around this week a little bit up, a little bit down. What's your thoughts in this cattle market here on Wednesday?
I continue to be amazed at this point, Jesse, of the strength in the futures market because of the cash market not getting established. We know the kill is there. It's 128,000 head on Wednesday on Tuesday for the cattle here in the United States. So it's up there, but I'm just amazed at this premium that especially the December futures continues to carry, still above 150, and we can barely get above 140, 142 in the cash cattle market right here, right now, with probably bigger supplies coming yet in the fourth quarter. So I still see quite a premium in the futures. I think it's a very hedgeable premium, especially if that rail strike happens. And my analysis would be we're going to see a cash market that's going to see a flooding of marketings because of the mixed feed. Yeah.
Hogs, a bit of a different story. That cash index, we've been seeing it collapse to try and come down to the October contract. It's still kind of been doing that here this week. Yet we've maybe found a little technical footing in this hog market.
I think that's right. I think the cash index coming down and the futures staying where it's at is actually supportive for the funds to come in and pick up a little extra length. I noticed on the Committed Traders report, they weren't that long in the hogs. In fact, there had been 3 or 4 weeks they'd been peeling back their net long positions. So I think that gave them some confidence to come back in. I still think at the end of the day, though, China is going to make or break our hog trend, our pork trend. And I think that's probably the path of least resistance as we get through September and into October is probably lower because the Chinese are going to have adequate supply and they're not letting people travel during these major holidays that they're having both in September and October. And I think that's just going to keep hurting our consumption base over there.
You watch a lot of the geopolitical side and do your analysis with that too. And I know you follow China quite a bit. I know there's the rumblings out there that the administration in the U.S. is getting sanctions together preemptively in case China invades Taiwan. And I've heard some stories as well. I don't know if I shared this with you, but stories about us getting parts here in this country for different, combines or ag equipment or vehicles from China. We're not getting them because China has put the U.S. down at the bottom of the list. I just think about this situation, how it continues to deteriorate. If it deteriorates further, what would that do to the agricultural economy here in the U.S. in the grand scheme?
I think it points back into the direction of what we're starting to see. The path of least resistance for China and Russia is to use everybody but the United States to help, to not help the United States, try and hurt the United States. In the case of China, it means go after as much South American product as you possibly can. So that's kind of where I'm at in the longer term, Jesse, is I don't see the type of demand from China that we've seen the last 2 or 3 years, A, because they're slowing down economically, and B, the politics. And I do think the sanctions are likely to happen because I do think the U.S. administration and the rest of the Asian Pacific Rim, from what I'm hearing, is they're very nervous about China coming in on Taiwan at this point.
Well, Mike, fantastic stuff, and it's great to catch up with you here in person at Big Iron. Before I let you go, any other final thoughts you have for us real quick?
No, it's just great and to be with you and meet you, and thank you for having me on every week, Jesse, and just really enjoy your program.
Well, I echo that sentiment. Great to meet you, and always appreciate the fantastic insight. I know folks can learn more. Global Com Research, com with 2 M's, right?
Global Com Research with globalcom with 2 M's.com.
Globalcomresearch.com. See, I can joke a little bit more when we're in person because we can build off that instead of looking at a video screen. Mike Zuzolo, Global Commodity Analytics. It's a pleasure, sir. Thanks for being on Market Talk today. We'll talk to you again soon.
Thank you, sir.